Hello everyone, welcome back. It's Paul Tilley. In this part of the unit, we're looking at decisions that business people make every day, and we use financial tools in order to help make those decisions. Particularly in this section, we want to look at two basic decisions. First, should we invest? Is this the thing that we need to do? You know, every investment has a certain expense related to buying it, and there are rewards that come of owning it. The question is, will the rewards be greater than the cost of buying it? So the should we invest question really says, can we make money on this? And we'll look at an assessment for that. The second thing we're going to look at is a common business decision these days, and that is, should we lease a piece of equipment or an asset or something, or should we buy it? So, without further ado, let's take a look at that in detail. The first thing we look at is a basic question that is paramount to all business. Should we invest? And when we think about investing, and we've talked within the context of this course, we've talked about the time value of money. The time value of money comes into play here because investments tend to be long-term. This is why we call it capital. Capital, and the term capital budgeting, comes from the idea that this is a long-term decision. It's not something that we're going to buy and use up today or tomorrow or the next day. This is a piece of equipment or some particular asset that's going to last a long time. As a result of that, the decision-making of buying it and the return from it really has to be considered over a period of time. So we really need to think about the time value of money. So essentially, when you boil it down in terms to the basic decision here from a financial point of view, we're comparing two things. We're looking at the cash flow in from a particular product. So let's say, for example, we buy a tractor. I'll draw a tractor. I like drawing tractors. So I'll draw a tractor. This is a wonderful little piece of equipment here. Okay, let's assume that we're buying a tractor, and that tractor is going to cost us, $100,000. Okay, so we're gonna do that. So that's money that's going out. Okay, that's money that's going out. And the thing is, we're going to use that tractor over its life, and we're going to make money on it. So let's say, for example, we're going to make $40,000 in the first year, and $40,000 in the second year, and $40,000 in the third year, and then we're going to sell it. Okay? So the question is, should we buy it or not? So we got 3 times $40,000 coming in. So I do the math on that, and I said it's $120,000. Now let's just ignore the time value of money for a second, okay? And let's assume that we sell it, for $10,000 at the end. Okay, let's look at this from a rational point of view, ignoring the time value of money. We are taking $100,000 out of our bank account now and paying for that tractor. Okay, we're going to get that tractor. Over the course of the next 3 years of its useful life, we're going to make $120,000 in revenue from that piece of equipment. And we're going to sell it for $10,000. So that comes to, again, ignoring the time value of money, $130,000. Now I ask you, should we buy that tractor or should we not? And your answer is probably at this stage, yes, let's buy the tractor. Again, why? If you don't understand why, well, we spent $100,000 and we made, it brought in for us, in other words, the cash flow in from the tractor was $130,000 when you consider the $120,000, $40,000 a year for 3 years, plus the $10,000 when we sold it. So that's $130,000. So $130,000 in is more than $100,000 out. So the business decision should be, yeah, let's buy the tractor. Now that's simplistic. And essentially, that's what it boils down to. That is what we're doing here, is we're making that simplistic decision. However, we're adding the wrinkle of the time value of money. Okay? We have to recognize that $1 today is worth a different amount than $1 at some point in the future. So let's take this exact same example, buying a tractor. I'll draw the little tractor again because I like drawing tractors. Okay, so essentially we are paying $100,000 right now. So in terms of the time value of now, the time value of now is $100,000, and that's out. Okay, there's $100,000 going out if we look at that. Now let's take a look at the future. Let's look in. So in year one, we have a tractor that is going to generate $40,000 for us in that first year. Let's assume that it makes $40,000 in the first year. Now the first year, the thing is with that is we need to look at what the time value of money is. So again, I'm assuming the $40,000, and there are some assumptions that I'm making here. The $40,000 comes in at the end of the period. Let's assume interest rates at the time. We're going to borrow on that to buy that tractor. Let's assume the interest rate is 20%. Really, really high. It's a really high interest rate. That's what the company can borrow for, okay? So when we go take that $100,000, we're getting a loan on it, we're paying $100,000 on it, that sort of thing. So we got to be able to draw in enough money to cover that. So from the point of view of here, in terms of the cash flows, we have to discount our cash flows to present value at a rate of 20%. So in order to do that, in the first year, we know that present value is the amount, which in this case is the payment, over 1 plus I. And that 1 plus I depends on what year it is, so the N. So we're just simply looking at 3 years. So in the first year, and again, I'm assuming very simplistic here that $40,000 always comes in at the end of the year. In the first year, then the payment is $40,000, 1 plus, and we said that the interest is 20%, 0.20 to the 1. So that's what that value will be worth at year 1. So that's 40,000 divided by 1.20, and that comes to $33,333. So essentially, what we're saying is that $40,000 1 year for now is worth that much. 33,333. It's worth that much now. Let's take a look at the second year though. And this is all predicated on, again, a 20% rate. The second year we have $40,000 coming in. We said that every year we're making $40,000 for 3 years. It's 1.20. Now again, that's I've just taken 1 plus 0.20 to the power of 2. And that is the same as 40,000 divided by 1.44, and that is 27,778. Again, I'm rounding here. But essentially, that 40,000 coming in 2 years' time is worth 27,000 now. Now in year 3, we're going to do 2 things. First of all, we've got the $40,000 coming in, and from the revenue on the machine, and that's 1.20 is the considering the interest rate to the power of 3 because it's 3 years. So that's 40,000 divided by 1.7228. $23,148. Okay, and again, I'm rounding again, but essentially that $40,000 in 3 years' time is worth $23,148 right now. Now, in year 3 as well, as soon as we're done with year 3, let's assume that, so it's still year 3, we're going to sell the machine. I said we get $10,000 for it. So we're going to take the $10,000 and we're going to discount that money that we're going to get in our hand in 4 year time. We're going to discount that back to today's, so 1 put 2 to the 3. Same, it's the same year, so we're using this same amount. So that's the same as 10,000 divided by 1.728. And that's 5787. So essentially, and again I'm rounding, so you got to be careful here to appreciate the fact that I'm not worried about decimals. This is for decision making purposes. This is not making payments, so we're just trying to make a decision. We don't have to worry too much about rounding here as long as we can get a reasonable answer. So essentially what we're saying is that if we took all these amounts of money, we brought them back to now. So essentially what we have to do is add all those up. So we're going to take the 5787 plus the 23,148 plus the 27,778 plus the 3,333.0, and that comes to 90,046. Okay, so here's what we've done. We spent $100,000 on a tractor. We're going to use the tractor for a number of years. It's going to generate revenue for us. We've calculated the revenue. We brought it back to today. What is the value today of these flow of money? The today value of that flow of money is $90,000. So we spent 100, we're getting 90 back. Should we buy the tractor with 20% interest rate? The answer, certainly no, we should not, because we're spending more than we're getting back. So when we make these decisions, this financial tool is a useful tool. Again, considering the time value of money, it's a useful tool in order to help make those decisions. The next thing I want to look at this unit is lease versus buy. Okay, so this is another common decision that is made by business people. As they say, well, should I lease something? Now, essentially, what a lease is, it is a stream of payments. Okay, it's a stream of payments. Now that could be paid monthly, could be paid yearly. It doesn't matter. There's a period of time. So the lease, the equal payments are made. And the thing is with leases is the payments are made at the beginning of the period. So it is by definition a due, and this by definition is an annuity. So really it's an annuity due. A lease payment is really an annuity due. And the other option is we buy it. Now, we just saw in the previous example there that in a buying, what we're trying to do is to calculate, we're putting a bunch of money down at the beginning, we're going to use it, it's going to generate money for us, and at the end we're going to sell it. So what we need to be able to do is compress all that back to get the present value of it. So essentially what we're doing in the buying case is getting the present value of the investment. And what we're doing in the leasing case is getting the present value of lease payments. Okay, so essentially we're looking at apples and apples here. We want to know what the value of that is today, what the value of that is today. We're comparing the two and we're saying which is least expensive. So in terms of the lease versus buy, this is a very important commonly used concept, and the essences are very simple. We compare a lease, the present value of the lease payments. We compare a buy, the present value of the machine in terms of its expenses when we buy it and the revenues it makes during its lifetime. And we ask ourselves, which is least expensive? And we're going to do a few problems on that. So I invite you now to take a look at the next video. In the next video, I'm going to look at some problems in 16.1, and it covers both of these topics.